Welcome to the daily update, where I'll go over the action in the market for Monday, July 8th, and then we'll see how things look for Tuesday, July 9th. A pretty slow day. We had a slight up day, so as I usually say, it goes in the books as a positive day. We're seeing volume drop off as the summer months begin to unfold here. There wasn't a real catalyst to drive the market higher or lower. On the positive side, you can say, well, we're holding up pretty good right now. Everybody, not everybody, there's a lot of people out there that are really predicting some kind of correction and that we're really going to fall 5, 10, 20, 100%, whatever. Those people are always out there. You have a lot of people that are really focusing on the positive seasonality. And to this point, the market's kind of at a stalemate, but it's holding together for right now. We are looking a little extreme positive in the short and even intermediate term, but on a trending basis, we're still looking quite positive. At the same time, we're still seeing this weakness internally develop inside the S&P. Before I get started, I do have a thing called the SPX Investing Program. It's free and it's wide open right now. It does require an email address to actually sign up if you want to go check that out. I'm posting some additional information that are not public videos that I post on YouTube or Rumble. This is just within the program. I have courses on there. I've got the basic course that's been re-recorded, and I have a course on technical analysis, strategies, and mental analysis that I'll be rolling out throughout the summer. That's the foundational information. And then the videos that I do, those are meant to supplement, saying, okay, what you learned as a foundation in the courses, here's how it's played out on a day-by-day, week-by-week basis. If you want to learn even more about that, there is a link in the description below this video and every video that I post that will take you to the website. There's also a link that can take you to a playlist on YouTube to go through some different videos where I explain the overall program. Excuse me, the overall program itself. Some folks are a little bit confused sometimes. They see all these videos posted by me and they're like, okay, what does this have to do with things? To me, it all comes down to the daily video and all the other videos that I do each week, like the weekly video, intermarket analysis, deep dive, what to watch. And there's even a few supplemental videos. Those are all tying into the daily video update. In my personal opinion, and in decades of doing this, day by day analysis is where we see things start to unfold before they actually begin to happen. It's where we can keep track on things or on track of things quite closely and then adjust or take advantage of things here and there. That's what I found to be the best form of analysis. But I know people are busy. My videos tend to be longer. I go into a lot of different areas. But the more you get involved in the markets, the more you realize that knowledge is power and what you don't know can really hurt you at times. So that's this graphic here is just to show you kind of the idea of all the videos together and how they're used as one basic unit. Let's go back and talk about what happened, and then I will go through the charts. We did have a higher open. The futures were positive. There's some, well, we had the UK election, and that seems to be pretty much resolved. But there was kind of a switcheroo in France over the weekend, and the folks that looked like they could have won ended up not winning, and that tended to be somewhat positive for the European markets. And then that fed over into the futures. And then we do have this basic positive backdrop with the stock market in the US. And that ended up leading to a higher open. Unfortunately, we hit the high right after the open. We went up to R1, and that was the resistance level that we hit. And that was the daily high as well. R1 was at 55.81. I was just kind of watching things. I don't pay an awful lot of attention to the open because there's so much just weird stuff going on during that time. I never get into any new positions at the open. I always get into them as close to the close as possible. But if I'm riding a position and we gap in the direction of the position that I have, yeah, I'll get out at that time. I'll certainly take advantage of that. So I kind of keep an eye on what's going on there. But the first hour to hour and a half to sometimes even 2 hours, you can pretty much, in my opinion, just kind of throw that out the window. It's later on in the day when the market is taken over by the folks who are professionals and really want to take things in one way or the other. Then right after the open, after hitting R1, we came back down to the unchanged level, and we actually dropped a little bit below that. It didn't really provide much support early on. Then prices went back positive, and we chopped sideways to close slightly positive. So there was just not an awful lot of conviction. We were up 0.1%, and volume is below average. Now, we're going to have some major reports coming out later in the week. We have CPI and PPI in Tuesday and Wednesday sessions. Jerome Powell is going to be testifying before Congress. One day he goes before the House, the other day the Senate. I can never remember which one comes first. This is planned. This is scheduled 2 times each year. He needs to make an appearance. He'll have his prepared remarks that he'll say. The market will be paying more attention on Tuesday because they're hearing these comments for the first time. And then they'll be paying attention to the Q&A session. Then on Wednesday, he'll say pretty much the same thing to open, and then it's the Q&A that is more of a focus. And we'll just have to see if there's any surprises that end up coming out of that. We are positive in the short, intermediate, and long term, looking a little extreme in the short and intermediate term, but that could also suggest good momentum, even though we didn't see much momentum in Monday's session. Later in the week, we're going to get CPI and PPI that will really feed into the whole inflation scenario. And then we've got the whole thing going on with the US election. The European elections seem to, even though they're not finished in France, they're at least calming down a little bit from what I could see. But there's still this real debate going on concerning the US election as well. And then just anything else. I mean, there's a couple of wars going on right now between Russia, Ukraine. There's a lot of hostility in the Middle East, specifically in Israel. Is that going to escalate to the point where it will actually have an impact on the stock market? Some comments, yet again, with the NASDAQ 100, NASDAQ, and S&P, and with some other sectors and indexes, we hit new all-time highs. Anytime we hit an all-time high and then even have the smallest of advances the next day, that's another new all-time high. And it wasn't so much the mega caps that did really well on Monday. It was the semiconductors. They kind of held things together. Here's our short-term list with the Stochk RSI, the Williams percent R, CCI 14 and 20, the stochastics, the boom indicator. We're still kind of far away from that 20-period moving average, and the shorter-term RSI based on 9 periods. This list hasn't changed, nor have we worked off any of this list. In the intermediate term, we still have the balance of power, the CMB composite, the accumulation distribution, one of our smart money indicators, standard deviation, we're still in that +3 channel, the Sean trend meter, and we're getting kind of far away from the 50-period moving average. That's the boom 50, and then the more intermediate term RSI based on 14 periods. The scenario really hasn't changed. We'll see if that does change later in the week, where the Fed is keeping rates higher for longer. We did see the employment report come out last Friday, and it was weaker than expected. That was so far taken as good news, but we're watching that fine line between good news being bad news and good news being good news, and reverse of that is also true. Because if we start to see weakness, this is what the Fed's been using to justify raising rates and then keeping rates higher for longer, because the employment situation is looking pretty good. Well, if that's starting to decline, then that could change some of the scenario that the Fed is doing. They're still, at the market level anyway, pricing in the idea that there's going to be a rate cut in September. So far, the market's just pricing in 1 cut. I've heard anywhere from no cuts to 10 cuts between now and the end of the year. Just roll the dice and come up with a number and post it on some form of social media, and a few people might even read that. The dollar was up, which could have put some pressure on stocks, but interest rates were pretty much unchanged. We round these numbers up and down. Interest rates were actually down slightly, but we still rounded up to 4.27% for the 10-year yield, which is where it was after Friday. We're still inverted with the yield curves. We ticked down a notch with sentiment. We're still in neutral territory. We had been at 54 after Friday. We're at 53 after Monday. As far as our trend, we're still in a trending environment. Now, in a short-term basis, we're starting to look overextended, and I'll show you that short-term ADX chart. The intermediate term is still looking pretty solid right now. It's above its moving average. Both of them are above 20, and it's continuing to go up, but we haven't reached that 40 level yet. We are positive with the up day, so that's our bias. And our momentum, I've changed it from mixed now back over to positive because we were chopping around there, not really showing a lot of conviction. But then with Friday's up day and a lack of a down day is the way I'm kind of seeing Monday, is we're still looking good with the momentum. Bias is one day, momentum is the last 2, 3, 4, 5 days taken together. We just had one economic report and that came out later in the day. There was a pretty big increase here with folks that are using credit now. Is that because the economy is hitting folks pretty hard and they're having to live off their credit cards now? They expected 9.5 billion of an increase in consumer credit. It actually rose 11.3 billion and up quite a bit from the 6.5 billion that we saw last time. And here's a chart showing that where it's starting to turn back up, where we had been looking at a decline on a year-over-year basis. And that's a little bit of a concern when folks have to borrow just to get gas or groceries, or just maybe they're doing it to go on vacation where normally they would have saved up the money. Debt can be a real problem, especially the kind of debt that folks have. And sometimes we see an increase of that as the economy is showing some real struggles. Here's the month over month change where we were negative, and now we've seen a couple of rising months from that, showing that there's an increase in consumer credit. Here's a longer term technical analysis chart. This is a weekly chart of the S&P 500. The reason I show this is they have different things on here than what I show. The cup and handle, yeah, okay, that's legitimate, but I don't really focus too much on that because sometimes I've seen the handle break and then it's really hard to pick up the cup. But these are just some projections, and since we're going up, all the projections tend to be higher. I was watching that 5,600 level. I was wondering if we could get up to that. Now, that's not a technical level, that's a psychological level. And the markets will kind of latch onto that, as well as the financial media and social media. They'll all, woo, 5,600. And for some of the economists out there, this was their projection for the year. And if we start hitting that already, that it could be a positive sign that we're going up. It could be negative, thinking, okay, well, we've already hit our target, let's sell. So this just marks some different areas of support or resistance if we continue to go up, or support if we start to come down. We're still looking really good here on a trending basis. We have the moving averages all going up and prices above all the moving averages as well. This is also showing, and on the website I posted, I'm starting a weekly video there that's not a public video, or I'm just going to do a weekly update of how do earnings look. And this is mainly by looking forward. I go over that in the intermarket analysis video where I look at historical earnings and then forward earnings, but I'm trying to break it down a little bit more to say, okay, are we looking more positive or negative as far as the earnings outlook? But when you look at the US, we have that PE ratio of 10, 15, and 20. Those are static numbers. We're above that 20 level. So even looking into the future, US stocks are fairly expensive. But as I pointed out in the video on the website, that's the Magnificent Seven that's really driving the PE ratio up. If you do the median measure as measured by Edward Yardeni, who's an economist that I actually kind of respect, which that's not a very big group, but the rest of the S&P 500, the equal weight, that's not overvalued right now. That's actually been declining. Now, you could take that in a negative way, saying that, well, it's just a few stocks that are really pushing the market higher. And that's true. And if those stocks start to take a rest or see some profit taking, that's going to bring the indexes down since they have such an impact. On the other hand, if we can see the rest of the market start to gain a little strength, which we're not necessarily seeing right now, but throughout the summer months, begin to see more of a broad participation inside the S&P, that could really help the broader index itself to show more strength. And then when we compare the US forward-looking PE ratio with the rest of the world, we're well above all those other countries, which you could take the stance, well, yeah, it's because we have the best companies and we have the best stock market and we have the best economy. So we should be above all these other countries. On the other hand, it's like, yeah, but we're getting kind of expensive at this point. Then I'm not going to read off all these names. These are all the Federal Open Mouth Committee members. And then where they voted, whether they're more hawkish, they want rates to go up, or be more stringent on the financial policy, where you have the more dovish folks and how they voted and all of that. You may want to pause and look at this just to see if you might recognize some of these names like Kashkari, Mester. Every once in a while, I'll bring up their names when they do a speech, but it's Chairperson Powell that is really the talking head for the FOMC. And we're seeing a lot of inflow into investment grade bonds. And I pointed this out over the weekend before I even saw this chart. We're seeing folks having a tendency to get out of the riskier bonds, junk bonds, and they're starting to get into more investment grade bonds, which are more conservative bonds, whether they be government bonds or corporate bonds. And we're seeing some money really going in at this point. That could signal that maybe interest rates have topped out and they're going to start coming down. And so instead of getting into the riskier junk bonds that give you a higher yield but also carry more risk, folks are willing to get out of those and get into safer bonds that they feel that yield will be attractive going forward from here. Now, we don't know. We've been faked out by this a number of times over the last year or two. But this is just what we're seeing right now. We keep an eye on that and see if it still develops further. And the okay, let me try this again. The consensus expects earnings to rebound further. This is according to Yahoo Finance. And this really gives some rationalization and even confirmation that stock prices could go higher, because we're seeing earning estimates going up into the future. And that's kind of what I pointed out in the other video on the website, is that at this point anyway, earnings are looking okay when you project them out into the future. And then bank loans see largest inflow. And I'm not into this 2 years garbage here, but we're just seeing more money going in and out of banks, which is showing still some confidence in the banking system. Not really seeing a meltdown necessarily at this point. And then this is a chart put out by Real Investment Advice. This is comparing 2023 with 2024. There is a bit of a correlation between the two. Now, remember, if you were following the market a year ago, we were just screaming up, and near the end of July, that's when we topped out. And then we had a 10% correction after that. Well, we came down and we bounced, and then we 10%ly corrected. How's that? Into the October low, and then saw a nice bounce up going into the end of the year. Are we going to end up seeing something like that this time? We don't know, but there's been kind of a strong correlation between the two when you compare one year with the next. This is kind of interesting, and I'm sure a lot of you still remember this. This was the very first issue of the Wall Street Journal. It debuted on Monday, July 8th, 1889. Now, that date's kind of interesting for a couple of different reasons. There was a person in Austria that was born in 1889 who ended up starting World War II. And this is also the year that the state I am from, Washington State, became a state. So a lot of major things happened in 1889, and I'm sure we remember them well. It's turned a little bit yellow over the years. And really, it's kind of interesting. You can look at this and go, yeah, that's the Wall Street Journal. It really hasn't changed all that much. The type and font that they use, I mean, it's a little bit crooked and it's not as nicely put together, but it hasn't really changed a lot over the years. Looking at our intraday chart, we did have a higher open. We went up and hit R1. That was the high. We tried to peek up above that a little bit, but it just wasn't happening. So then we drifted back down. We saw some kind of a sell program kick us down below the unchanged level, but then we bounced back up and then just chopped sideways, drifted a little bit lower, but then saw some buying going into the close. Intraday, really not an awful lot here. We were more negative with the futures, and then we started to make a comeback as we were approaching. Well, this was the initial overnight session on Sunday. And then we were pretty much flat, and then showed a bit of improvement as we were coming into the open. And then we are looking up. We're up about 0.25% right now in the initial overnight session going into Tuesday. We're looking good here. When we look at large cap growth, which is in blue, compared to large cap value on an intraday chart, that's positive.
And we're looking pretty good here. Didn't see a real big move here when we look at S&P growth to value, but it did end up going positive, and we have been bouncing up since the beginning of July, and this has been helping the indexes to go higher. Here's our end of day chart. Growth was up, and it was up more than value, and it was up just a little bit more for mid caps, up a little bit more for small caps. So not a bad day for growth. Here's our end of day charts. But when we look at the ratio on the small caps, not really breaking out yet, but not necessarily falling apart. The mid caps actually declined after seeing a death cross here with this ratio. The mid caps, which were doing better earlier in the year, just went into this sideways to slightly lower drift now that we've gotten into the summer months. This is looking good, though. The S&P growth to value ratio, end of day chart. We're continuing to go up, and that is helping the S&P. We're looking at our growth to value ETF. It declined just a little bit, but we're still really going up and well above the rainbow with this ratio. Discretionary, it was up. Staples were also up, so we saw a little bit of a tick up here with the ratio between the two. We want to see discretionary doing better than it has been, but I keep saying that every day, and it just doesn't seem to do it. Large cap growth, we did set another new all-time high. The large caps are also looking really good here when we compare it to small caps on a ratio basis. It declined a little over 0.5%, but it's still looking more solid with the large caps. The Wilshire, since it set an all-time high on Friday, any kind of an advance would set another new all-time high, which it did on Monday. And here's the intermediate term my goodness, ADX, the average directional movement. I'm trying to think of the acronym and the name at the same time. We are getting a little bit concerned. We're looking okay here, but we're starting to get above this 40 level. Even though we spent a long time going sideways, this was still picking up a strengthening trend, which ultimately broke higher. So we just want to be aware of this. We're getting above 40 with the ADX. Where we're going to get even a little more concerned is if the green line, which is still going up, even though it's really hard to see, it's tucked in behind the ADX. If that green line gets above 40, now it doesn't mean it has to stop at 40. It just means we are aware of this and we look for things to turn and start to change slightly. This is where we're already extreme. With ADX in the short term, we're just a little bit under 40 with the green line. We're dropping off with volume, and we're probably going to see that now throughout the summer months unless some major thing ends up happening to bring folks in to either buy or sell. And this is put out by Stock Traders Almanac. This just confirms that we're really starting to see a drop-off in volume, and that's pretty much seasonal. I mean, folks are going on vacation, and they're barbecuing, and they're going to the beach, and they're spending time with family. So we tend to see volume drop off here. This is NYSE volume, and we're also probably going to see a drop off in NASDAQ volume as well. Very common. There have been times over the decades that I've been doing this when it's like, my gosh, usually the week between Christmas and New Year's, that's slow because everybody's doing different things. Sometimes the last 2 weeks in August can just be so boring. It's like, okay, you can treat it like between Christmas and New Year's. But then there's been other times when the market has just steamrolled one way or the other and during that period of time. Looking at sentiment, here is the weekly chart. We're getting up into this extreme greed territory with this particular chart at 79.6, where we're more neutral with the gauge that we look at. And looking at the insider transactions ratio, this is legal insider transactions. CEOs, corporate officers, major shareholders who have to report what they're doing. We're seeing this actually dropping down a little bit right now, which could end up being bullish. And when I show that chart, I show this next chart, which is the insider buying ETF. We're pretty much, you're seeing some kind of a triangle or wedge or whatever you want to call this, pennant that's developing, as we're not seeing an awful lot of movement in this ETF. The Ulster Index still giving us very low readings on a sentiment basis. We'll get another reading later in the week from Investors Intelligence. We're above the 3 level. We get really nervous if we get above the 4 level. That means we're a little too extreme positive. We tick down a little bit here with the VIX on a closing basis, and we're also dropping off and closing near the bottom of the bar with the bar chart. And with the update, we declined just a little bit with the VIX of the VIX, even though we're seeing a series of of higher lows, and you could make a case for higher highs where there's a little bit of anticipation that volatility just might pick up. But as far as the momentum, the MACD is pretty much right on top of its moving average right now. It's not really going up. It's not really going down. And this is the VIX seasonality. And I remember showing this a year ago in the videos where this is kind of what we've been doing compared on a seasonal basis at the beginning of the year. And then what will often happen seasonally, doesn't mean this is going to happen, but this has historically happened, is in July, about the middle to latter part of July. That's when we see the VIX really start to pick up in volatility going into October and then starting to fall back down as we get into the rest of the year. Now, the VIX going up typically means stocks are under pressure. So we'll have to see if something like that actually plays out. We're getting a reading from the SKU index. We're just barely into this red area right now. This is different from the VIX. The VIX calculates using at-the-money options. The SKU index calculates by using out-of-the-money options. And we're starting to come up to this red area. Now, we don't know. Is that going to mean an upward move or a downward move or just a continuation? The last one that we had, we paused for a little while and then broke higher. There's been other times when we hit one of these and that marked an actual top. So we'll see. We have to wait for this to actually spike. So it'll need to continue to go up, spike, and then start to come down. This just means that the market is expecting some kind of a big move, but whether it's going to be up or down, we're not quite sure. Here's the one-day chart of the equity put call ratio, and I go back and forth whether I'm going to drop this from the video or not, but we really dropped off here after the weekend. And for a lot of folks, it was a holiday weekend, so they may have been taking some hedging off. And I'm also kind of frustrated with this. Sometimes this 5-day chart of the equity put call ratio seems to be rather helpful, but we've been chopping around so much lately, it really hasn't helped. It's going down for right now, which tends to be more positive. Now we're getting down close to this red line, which is an extreme reading, but we'll just keep an eye on this. So because the 5 period has been so frustrating, I also follow a 10 period simple moving average. I've watched this chart for years and years. I just haven't been showing it in the videos. This might help us from time to time when we're not getting a lot from the 5-day. This is showing a gradual decline when we look at the 10-day average, and that's more positive for the market. But when you look at volatility risk premium, we're just screaming off the charts here. We're just really continuing to go up. This is suggesting that, like right now with buying options and hedging and stuff like that, options are typically more expensive when we see this reading very high because folks are anticipating some kind of risk in the market that we're not seeing in the other sentiment indicators that we follow. This fear gauge is actually declining, and we declined just a little bit with this other fear gauge. I know it looks like it's going up, but it actually ticked down 0.16%. I want to keep an eye on this too. Usually I only go over this in the weekly video, but this is a little bit of a concern here when we look at the spread between risky and not as risky bonds. Now, for a long time, it's been going lower, and so this hasn't been a concern. As this goes down, that just means there's not a lot of fear in the bond market when you look at the spread between the two. And by looking at this chart, it's like, okay, yeah, everything is still looking fine here. But when we look at this high yield, this is high yield junk bonds, the credit spreads, and the VIX. You can see here where this black line is just barely starting to turn back up a little bit. And not a real concern, just something we want to be aware of as the VIX continues to give very low readings. This is where it's a little bit more pronounced. This is a shorter term chart, and this is also inverted to match up with the price action of the S&P. This is the concern right here. This is the spread between the risky and not as risky bonds. When this is going up, that means there's not a lot of fear. When this starts to come down, that means there is fear that's increasing. Now, it's not crazy yet, and we've dropped before and everything turned out okay. But since this has been coming down, we just want to keep an eye on this. And then we can also compare that to the VIX itself, which, again, is on an inverted scale here. Then I haven't broken this chart out. I've pretty much put this in the deep dive video now, but we're seeing the risk on to risk off ratio start to go up, which as folks are getting more risk on. We're not really breaking out here. We've been just bouncing around. We were in a higher range, at the beginning of 2024. Then we jumped into a lower range. Now we're starting to go back up. This means that folks are getting into the big stocks right now, where risk off would mean they're getting into more conservative stocks or stocks that tend to do better when we're under pressure with the market. This is kind of interesting. I actually found this on Twitter and I thought, okay, yeah, here is the price of the stock of Ferrari and compared to the consumer discretionary. I mean, you can't get more discretionary than Ferrari. My goodness. Of course, my biggest problem with this is which Ferrari am I going to drive today? That's then talk about a major struggle. But you can see there's a pretty strong correlation between what the price does and what consumer discretionary is doing. They tend to go up and down more or less together. So what I did is I created a chart. Here's Ferrari on top. Here's discretionary in the middle area. And then I do a longer term correlation where over the longer period here, you can see that there's a pretty strong correlation. The higher this reading, the more the top chart and the middle of the chart are correlated with each other. Now we're dropping off now. We're not as strongly correlated as we were because Ferrari's been chopping sideways. Maybe it's on cruise control right now, where discretionary's actually been seeing a bit of a bounce where we're seeing some improvement in Tesla. So we'll just kind of keep an eye on this. It's kind of a fun chart to look at. And then our advanced decline line study, still seeing that negative divergence based on price inside the S&P. It has not been able to break out above this previous high, but that's the negative side. But the positive side is volume continues to hold up quite well. Also, the new highs, new lows. We saw a little bit of an expansion of the new highs, not enough to turn our 5 period up, and we're still declining to flattening out with our 10 period. This is another internal measure that we've been watching with a little bit of concern. This is looking a little better. The advanced decline ratio, both short-term based on 19 periods and intermediate term based on 39 periods, just barely crossing back above zero, where they were just barely dropping below zero after Friday. This is looking good, maybe a little too good. Maybe this turn down is actually giving us some insight, but the accumulation distribution, which to me is a smart money indicator, because it not only measures price, it also accounts for volume. We're well above the moving average, and the moving average is going up. That's positive. We came down just a little bit as we're flattening out here. We got above this red line, which I put on here just at the arbitrary 100 level. It's coming down. Now, we could turn and go back up. We don't necessarily have to stop here. There are other times when we go above this red level, but this is something that we want to keep an eye on as far as what is the smart money actually doing. And this is also a little bit of a concern. We're still positive with the Chaikin money flow, but the moving average continues to decline. And we actually saw a tick down here with the histogram. Chaikin oscillator, it looks like it's topping out a little bit, or at least slowing down for the time being, but still remains positive. So our smart money indicators, when we take them all together, yeah, they're positive, but just flashing just little warning signs that we want to pay attention to. When we look at the cumulative advanced decline line on the NYSE, we had an up day, so we're going up there. We actually ticked down just a little bit with the regular NYSE advanced decline line, ticking down, but still above the 50-day moving average with the other NYSE advanced decline line. And then we break it out based on price with NYSE common stock, just kind of chopping around, not really doing much, seeing a little bit more of an improvement, but no real convicted strength here when we look at this based on volume. This is where we have a negative and a positive. We're chopping sideways with the cumulative S&P 500 based on price. We're breaking out and looking even more solid based on volume. So the price is negative, the volume is positive, and that would be potentially positive if volume is actually leading price. Seeing a little bit of a tick up here when we look at the negative divergence between the S&P, which has been going up, and the NYSE advanced decline line, which has been chopping around sideways. And seeing a little bit of an improvement, but still overall weakness when we look at the advanced decline studies here. We ticked up, but still below the moving average with the NYSE common stock, right on the moving average with the S&P, turned up, but still below the moving average with the mid caps and the small caps. Here's our daily chart, wondering if this pivot point is presenting some kind of a problem here as overhead resistance. We came right up to that level, and we've not been able to break above that and close above that, at least yet. On the bottom, we are below average with volume. Now we look at our short-term oscillators, and they're pretty much all extreme positive with the Stochk RSI, the Williams percent R, the CCI 14 and 20, as well as the stochastics in the short-term, intermediate short-term, and the long short-term. I like to explain this. This is a further subdivision of the short-term time frame. But we're still looking good on a trending basis. We look at our double and triple exponential moving average based on 20 periods. We're above the lines, and the lines are going up. We saw a little bit of an improvement here. This was a little bit of a concern after Friday when we had an up day and these moving averages were going down. Well, we went up with the 20. We're still flat to declining with the 50 and turning back up with the 200 slightly. Force index continues to be positive. Another short-term indicator. We're above the short-term moving average that I base it around 20 periods. That's still looking solid. We're up into the +3 channel again. When we look at our standard deviations channels here, we're still looking extreme positive when we measure how far away we are from the 20 and 50 period moving average. We're showing a little bit of improvement with the distance away from the 200 period moving average. Intermediate term, we're still just right at this black line. Again, I put the black line on here, so there's nothing magical about it, but we're still extreme with the balance of power. We're still looking good on a trending basis when you use the go, no go system. We're still looking good with our highest high value chart. And we're turning back to a darker shade of blue again with the TTM squeeze. It was shifting over for a couple of days, at least one day there. With the lighter shade, that's more positive. When it switches back to darker blue, that's a little bit more negative. When we look at the double and triple exponential moving averages based on 50 periods, we're above both the lines. The red line's going up. So the intermediate term trend is still looking solid. I haven't even been showing the 50 period simple and exponential moving averages in the video because we're so far above them at this point. CMB composite is still extreme positive. Ease of movement turning back up and is positive. The Erin is going up now, and we're not quite extreme positive here when we look at the oscillator, which measures the difference between buyers and sellers. Showing a little bit of improvement, but still negative here with the S&P McClellan oscillator. We're below 0. So we're still declining based on price, and we're starting to turn up with a little bit more conviction based on volume. That could end up being positive when we see volume leading price, but we need to see it ultimately confirmed by price action. The NYSE McClellan oscillator is actually more positive and ticked up. It's above 0. So we're seeing a slight turn up with the NYSE summation index based on price and volume. And the Swenlin trading oscillator, we're negative based on price, we're positive based on volume. Could be a leading indication of upward price movement, but this indicator, although I put it right on the border between primary and secondary as far as importance. It's given us some really good insight in the past, but it's also given us some false signals too. There's no indicator that's perfect. Trying to turn back more positive with momentum. We're going back up with the PMO, but we're getting back up to this extreme reading. We're declining and right on top of the moving average based on price. We're starting to turn back positive based on volume. That could be positive. So we saw a little bit of an improvement with the PMOs that are rising. We're declining but flattening out with the buy signals, and also declining and flattening out with the PMOs that are above 0. On a trending basis, we continue to be positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're trying to turn back and look a little more positive with the slope oscillator. This is a short-term oscillator. The MACD is crossing above its moving average. That's more short to intermediate term. So with our short-term oscillators, we're trying to look more positive here, turning back up with the MACD, the PMO, you think I could say these letters here, and the PPO, we're looking a little bit better with the tricks, but we're still right on top of the moving average and somewhat declining with the KST. Those are our two longer term oscillators. Still above all the lines here as far as a trend when we use moving averages. And this is still a concern. The bullish percent index is just not doing much these days, even though it's still above 50. And we just barely ticked below 50 after Friday with the NYSE bullish percent index. Now we just ticked barely back above 50 after Monday. And we came down a little bit, but we're still positive with the NASDAQ 100 bullish percent index. After dropping below 50 with the money flow, we came back above 50. And after going up, we actually came down with the ultimate oscillator, but it's still positive. The vortex is still positive with the green line advancing. We're still looking extreme with the RSI based on 14 as well as 9 periods. And on balance volume, it goes in the books as an up day. So on balance volume is all counted as positive. And I wanted to bring out the standard deviations chart. As we were going sideways, standard deviation based on 10 periods was really dropping off. Then we saw the little up thrust here. That's starting to come into the calculation, and we're coming right back up to the moving average. Again, standard deviation is not measuring direction, it's measuring speed. So if this continues to go up, that just might mean there might be more of an up thrust with the S&P itself. When we look at those stocks inside the S&P above their 20-day moving averages, we improved, but we're still below 50. So that is negative. Seeing a little bit of a tick up here with our 20-period study, but not the big thrust that we have been anticipating. We're also negative when we look at those stocks above their 50-day moving average. We're negative with those stocks above their 100-period moving average, and also turning up a little bit here and positive with those stocks above our 200-day moving average, but we have been declining lately. The copy curve continues to be negative. This is another momentum oscillator. The Pring bottom fisher, maybe it's waking up and saying, oh, we didn't hit any kind of a bottom here. Maybe I shouldn't be generating a buy signal after all. At least it's thinking about that. The Sean trend meter continues to be extreme positive. Looking a little bit more positive here on a broad market basis. When we take the 5-period moving average of the highs minus the lows, we're crossing back above zero. We're coming in at 62 with the latest reading. We're still above this R2 level here. This is a weekly chart of the S&P. This is beginning the 4th week now where we've been above this level, and that could continue to be positive for the S&P. We're breaking out above this 50% fib extension now, where this had been providing some overhead resistance. We came back down, and then we were able to break through that. But when we look at everything based on trends, we're going up with the Heiken Ashi, up with the Kagi, up with the Renko, up with the 3-line break. Long term, we're still seeing this negative divergence with the 150 and 200 period moving averages, but they're still positive anyway. We're negative in the short and intermediate term with the mid caps. They've really just kind of taken a back seat after showing some real strength earlier in the year. And we're negative with bonds in the long term based on price, and we're still in a downtrend in the short term with the dollar. No changes here with the decision point scorecard. So when we saw that nice little up thrust right at the open, an awful lot of positive things happened with the S&P setting an all-time high. We got above 18.2 and then 18.3 with the NASDAQ discretionary. That's an area we'd like to see improve. We had industrials have a MACD bullish crossover. And the NYSE, that's the chart I just showed. We ticked back above 50 and we got above 18.4 with the NASDAQ. And then as we were drifting later on in the day, well, Canada pulled back a little bit. Then we dropped below 50 only to come back and close back above it. First, the dollar went below 105, then it went back above 105. Utilities generated a signal above 80 with the bullish percent index and then fell back down below that. The sectors, tech and materials ended up, well, tech was the strongest area. Materials were positive, followed by real estate. Utilities were up slightly. Where we saw communication, there was some profit taking in that area. And we're looking a little positive here. The squiggly line that looks like a really erratic EKG, that's the one-day score for new highs minus the new lows on the NYSE. We're coming in at 70, and that's positive. Other charts I have show the moving average, which is based on 50 periods, we're actually break it out, so it's a little bit easier to see. That's not necessarily what I'm following right now. I'm just following the daily raw scores. We look at the S&P, which is the bar chart, and then the equal weight, which is the red line. And we're pulling back just a little bit. We just have been skyrocketing up, meaning that the big stocks are really outperforming the rest of the S&P right now. So a little bit of a pullback on Monday. The Dow kind of went up and closed near the low. Not sure if that's a concern or not, but it's still above its 50-day moving average. And we've gone from being positive to neutral for the diamonds when looking at the Elder's Impulse system. The NASDAQ is still above this R1 level. And so that what had been resistance so far has been holding up. And we're seeing price still above this R1 level for the NASDAQ 100. We continue to be positive with the QQQs when looking at the Elders Impulse system. The momentum has shifted back to positive for the NASDAQ 100. And we're also breaking out above this 38.2% fib extension level, where this had been providing overhead resistance. We fell back and now we're continuing to go up. Can we keep going up from here? This has a positive side and a negative side. The QQQ equal weight is setting another new all-time high. That's positive. We're not seeing that with the S&P equal weight index. So that's negative, and we're also seeing a negative divergence. These two charts are not confirming each other currently. The small caps were up a little over 0.5%. Sorry about that. I have to get something out of the oven. But we're still below the 50-day moving average, and we're positive with the trend when we look at the Elders Impulse system for the small caps. We're right on the 50-day moving average when we look at the Russell 2000 small caps, a little bit above 50 with the RSI. The momentum is trying to turn back positive. The mid caps just floundering, chopping sideways to even slightly lower. We've gone from being negative to neutral with the Elders Impulse system for the mid caps, but we're up again here with the total US stock ETF. That's setting another new all-time high. Apple was up, setting another new all-time high. We were up 0.5% with Tesla, which is kind of coming on strong these days. Can you imagine shorting it down around this area? Man, you've just been getting hit hard. And NVIDIA was up 1.88%, not setting an all-time high, but looking solid. Microsoft saw a little bit of profit taking, and we were down almost 2% with Meta. Amazon saw about 1/3% of profit taking. Google was down 0.82%, but still looking very solid. Netflix was down 0.71%, but also looking quite positive. The FANG index was unchanged. So you can't say it set a new all-time high, but it didn't break below the all-time high that was set. The financial sector was down 0.25%, but still above its 50-day moving average. So we're continuing to see this ratio decline. That's what we want to see when we compare the staples to the tech sector. We want this to go down to mean the tech sector is outperforming. The dollar is still in an uptrend. It was up in Monday's session and coming back up to its moving average. And we're seeing a little bit of an improvement here when we look at the S&P with the world index. The short-term relationship's getting a lot stronger, where the longer-term relationship is still continuing to drop off. We look at the staples sector, still looking strong, even though it was down slightly. We're coming back more to neutral when we look at the relative strength momentum. Now, this measures the relative strength on a momentum basis with the S&P 500. Seeing it's still negative when we look at the relative strength ratio between the staples sector and the S&P 500. Also seeing a little bit of improvement here with the utilities based on momentum, turning up but still negative with the utilities when we look at the relative strength. And utilities were up, but still underneath their 50-day moving average. Real estate still chopping more or less sideways, looking kind of positive, but weakening with the momentum and negative here with the relative strength. And also seeing that with energy, just cannot get above that 50-day moving average. So the momentum is dropping off, seeing a little bit of an improvement with the relative strength. Then we look at the 10-year yield, which did tick down just slightly, but I had it listed as unchanged, and we were up just a little tiny bit based on price with the 10-year ETF. We're still going up. The market is still anticipating that there will be a soft landing, and that means we'll avoid going into a recession. And we're declining here when we look at how bonds are underperforming stocks. That's an inverse of the chart that we just looked at. We want to see this continue to go down to stay positive. When we look at the broad market, the S&P 1500 is still going up with shorter term bonds. This other broad market measure is also going up when we look at 3 to 7 year bonds. The Qs are outperforming 3 to 7 year bonds. The tech sector is outperforming 3 to 7 year bonds. This is a concern and possibly a moment of truth here. The home construction to 3 to 7 year bond ratio coming down to the 250-day moving average, and right now has bounced up off of that. That's what we saw earlier. Actually, it was in late 2023. Is that going to happen this time as well? We're just keeping an eye on that. And then looking at some improvement here with the Qs to S&P, We're showing some improvement with discretionary to the S&P. Large cap growth is still doing well when compared to large cap value. So the large caps are looking good, doing with the mid caps and a little bit better with the small caps. And we're negative here when we look at one part of this chart. This is the advanced decline ratio. We dropped below zero, or excuse me, we're right at zero when we look at price, looking a little bit more solid when we look at this based on volume. The S&P to utilities ratio continues to go up. The staples to S&P ratio continues to go down, even though it ticked up a little bit on Monday. This is positive overall for the S&P. So what's our outlook? We're positive right now, but we still see these negative divergences and this weakness mainly inside the S&P itself. Banks are going to kick off the earnings season that's coming up here, and that'll start later in the week. Just be prepared for that. We're going to get no economic reports, but Fed Chair Powell will give day one of the congressional testimony. And we want to keep an eye on all the crazy things that are happening in the world just in case they impact the markets. So there's no economic reports on Tuesday. We're also going to get day number 2 on Wednesday of Fed Chair Powell's testifying. The big one's going to be CPI on Thursday and PPI on Friday. And then here's where it talks about how Chair Powell will be talking on Tuesday. And if you can hear my cat in the background, he's just singing hello to everybody. We're neutral to positive with the Dow and the S&P based on seasonality, where we're looking pretty positive with the NASDAQ. And we don't see any real edge here. We're actually ticking down a little bit during an election year. When we look at the green dashed line, that's during an election year for the S&P. And Tuesday is kind of flip of the coin. Tends to be a little bit more negative, but not necessarily positive either. Showing this a little bit longer term here, we're now coming into July, where we tend to see an overall upward trend going into about the middle to latter part of September. Also, this tends to be a good, solid time for the NASDAQ coming up into the early part of July. We're going through that right now. But maybe we're getting a little far away with the S&P when we compare it to all these other averages that we've been seeing. And the first part of July tends to be quite positive. The second half, it's positive, but not all that great. And then here's another Carson chart showing that the first 2 weeks of July is historically very strong. That's what we're dealing with right now. So our warning signs, we're watching staples, we're watching utilities, we're wondering if energy is going to be defensive or if that's offensive right now. And we're keeping an eye on healthcare. These areas, not so much energy because that's more variant. It doesn't always happen that way, but staples, utilities, and healthcare, if we see some real strength in those areas, that's when the market is generally gearing up to be more defensive, which means they're anticipating a decline. The advanced decline lines still showing weakness. We're seeing growth to value for the S&P looking pretty good, but discretionary to staples, not so much. The S&P McClellan oscillator and summation index, they are now both negative. And the Swenlin trading oscillator, it's negative based on price, positive based on volume. Copy curve is still negative, and I put this on here. Inside the S&P, the 20, 50, 100, and 200 period moving averages are negatively diverging. And then we look at our positive side. Here we take the smart indicators together. Accumulation distribution, yeah, but maybe a little too positive. Chaikin money flow, yeah, but maybe seeing a bit of a decline. Still looking a little more positive with the Chaikin oscillator. The parabolic SAR is positive. The bullish percent index is above 50, but it's just kind of not really doing much. The NYSE McClellan oscillator and summation index are both positive. Bullish percent index is improving. The equity put call ratio is going down. I'm not going to put the 10 period on here for right now. I want to see how that plays out a little better, even though I've been following it for quite a while. Our oscillators are trying to turn back up right now for the S&P. The money flow, after being negative, has now gone back to positive. The ultimate oscillator is positive. The vortex is positive. The Pring bottom fisher is generating a buy signal. And the financial sector is positive, and both the momentum and the bullish percent index for the NASDAQ 100 are positive. So our conclusion, we're positive, but we're seeing this internal weakness inside the S&P. In the short term, we're still positive, but we're looking a little extreme positive. Intermediate term, this is where we're seeing more of the internal weakness, but we're also showing some extreme positive readings. In the long term, we continue to be positive, but we're seeing those longer term moving averages negatively diverge. Thank you. I hope you have a really good day, and I will talk to you in the next video.